Welcome to Real Estate Coaching Radio, starring award-winning real estate coaches and #1 international best-selling authors, Tim and Julie Harris. Real Estate Coaching Radio is the nation's #1 daily radio show for realtors who demand authentic, real-time coaching. Get ready for fluff-free, unfiltered, full-strength honesty about what's truly working to get you into action, helping others, and making money now in today's real estate market. Now to our hosts, Tim and Julie Harris.
Welcome back to Real Estate Coaching Radio. We are your hosts, Tim and Julie Harris. Get ready, get buckled in, and be ready to take notes. We're going to be deep diving more into investing, and this is going to be, I think, the third or fourth part series that we're doing on property investing. And of course, we're taking the usual Harris Rules approach, making it practical and tactical. So get ready to take notes. Julie's going to be giving us some actual math, basic math, the basic stuff you need. Yucky, as Zoe would say. But we're going to be giving you the math on multifamilies, and we're going to be integrating it. And I think hopefully what you guys will agree is easy to swallow, easy to understand bits of information. It's very important, and Julie said this yesterday, that you don't just summarily write something off because it seems a little complicated. We know some of this formulaic approach to investing in real estate does seem a little complicated, and so what we're going to do is break it down and make it very simple. And we're also going to give you all of our hacks, all the things we've learned over the past couple decades from property investing, and obviously working with all of our coaching clients to property invest. By the way, guys, I do not know a single multimillionaire, or I'll go as far as to say I do not know of a single multimillionaire or billionaire who do not have at least half, if not a majority, of their net worth in real estate. One of the things that, if you study history, that has always basically passed through generations, gold has, silver has, a lot of times that stays in families as part of a family dynasty. But the one thing that everyone seems to have always kept their wealth through thick and thin, through good times and bad times, has always been real estate. And the wealthiest families in the world have always held their wealth, their greatest portions of their wealth, in real estate. So just, I guess maybe there's something we can learn from, all the history of man to maybe follow in their footsteps. So Julie, before we get to the first point, I know you have some folks you want to acknowledge.
Some quick shout outs. On yesterday's podcast, we were hearing from Robbie Quinn about completing his prospecting session where he was circle prospecting around a listing he just put under contract. Well, it wasn't so much later that Rhett Jared posted, just sold my first listing at 99% list, 2 days on the market, record high sale price for the development. Now I've got to go tell the neighborhood, check out the marketing I used to get some attention. So he posted that, and a lot of times, Tim, I know that these agents are posting on our private Facebook page for a little bit of accountability. So he had a lot of back and forth, and looks fantastic, nice job. And I'm also using this on the podcast to kind of turn up the heat so that he can get the next listing in that neighborhood, showing off that he was able to sell it quickly and for top dollar. So that's all good. Then I have several people requesting role play partners, accountability partners. The place to do that is on our premier call. You guys always connect with each other when you go to the daily call that I run right after the show. And let's see, I think that's a lot of people introducing themselves, but those are my shout outs for the time being. And then I'm anxious to jump into this commercial multifamily, how to evaluate, how to calculate some of this math. It's not my favorite thing in the world to do these word problems, but I also know from running the Premier Coaching call, Tim, that many agents, when they see something like operating expenses, capital expenditures, net, NOI, I don't know anything about this, I'm going to have to refer it off. Or I'm not even going to call that lead back. I'm not going to email them back. So I'm doing it to educate them, but also to make them more money. Go ahead.
So you mentioned Rhett Jared. Actually, I wanted to read this. This is from our private Facebook page, but I think, guys, it's very telling. A lot of you are looking for motivation to do what you don't want to do, and you don't want to do it at the highest level. And even paying members of our Premier Coaching Program, you guys go to the private Facebook page, and I can tell some of you have basically had a lifetime of silver bullets and easy buttons, and you think you're going to find more on our in our coaching program, and you're not. We're not going to lie to you. We're not going to deceive you guys in any way with regards to easy buttons. It really does. If you want, look, there might be an occasional something you can get from buying a lead here or there, and maybe in some markets buying buyer leads might still work. It's not a summary. You can't just summarily assume that in all markets buying Zillow leads doesn't work, because it might. You might be in a market where there's not a lot of competition from other agents trying to buy leads. So just remember, Julie and I are kind of agnostic about where you get your business as long as you're getting business. And where you guys are sort of confused is that you are in denial that what you're trying to do is not getting you business. So you will continue doing things month after month that don't work because you think that somehow maybe if you just dig deep enough in the earth, one day you'll strike oil. And that's insanity, because you're just going to go broke unless you have really a huge budget to blow on silver bullets. I strongly suggest that you just cut right to it and do what you don't want to do when you don't want to do it at the highest level. So Rhett Jared, who I know is a listener and also a Premier member, this is his actual post, and I thought this was great. He goes, just sold my first listing at 99% list, 2 days in the market at a record high price for the development. Now I got to tell the neighborhood, check out the marketing I used. Okay, so Julie talked about that. Now I was the first. Now there's been 55 people that have commented, but here's what I said: congratulations. Where did you get the listing lead in the first place? And then he responds, your FSBO script. And I respond, boom, excellent. Drill down, use this as proof. You'll never, as all the proof you'll ever need to know that real work gets you real results. And I said, lock it in, Rhett. And then we go on, basically, there's this long conversation of basically people coaching clients and Rhett kind of coaching them as far as like, lock it in, don't screw around, just realize that the greatest opportunity you can have in your life, not just your real estate business, but in your life as a result of the success you have from selling real estate, can come from just living the mindset, living the lifestyle of doing what you don't want to do when you don't want to do it at the highest level. Guys, look, we have, there's 40 Harris rules in the book, but truthfully, there's probably about another 40 that Julian had written down. We just didn't put it in the book. Maybe the updated version that's coming out in a year, we'll put those in there. But here's the real bottom line. If you want something that other people don't have, you have to be willing to do what they're not willing to do. In other words, if you want to have a great body, you're going to have to do something really onerous, like going to Orange Theory every day. It's terrible, but we do it every day. And a lot of our top clients do something with Orange Theory or something similar. If you want to have like a lot of ever increasing levels of success, a lot of people believe that you can only have a good month then a bad month, or a good year then a bad year, maybe a good couple years and a bad couple years. And so they set themselves up to experience those, those highs and lows throughout their entire lives. Same with health, same with relationships, same with everything. Why? Why do you do that to yourselves? It doesn't have to be that way. If you work consistently doing what you don't want to do and you don't want to do at the highest level, why wouldn't you always have ever increasing levels of success and happiness and health? Why wouldn't you? Now, obviously, one day you'll die, but other than that, why wouldn't you actually decide to work consistently? Because when you work consistently, it gets easier. So you guys have been hearing me and Julie bitch about Orange Theory since we started to go last August. And I have to tell you, it's getting a lot easier. And then we're amping it up. Julie's, I don't even know what, 5x'd her ability to basically exercise on the cardio, on the runner. I don't want to get too much into Orange Theory, but you guys get the idea. If Julie stayed locked in doing what she didn't want to do, and she didn't want to do it at the highest level for a long period of time, and it paid off. So listen to Rhett, listen to all of our thousands of other coaching clients, and just make this year the year that you're truly going to master doing the hard work. Now, I want to also, Julie, touch on the fact that we are going to be doing the Harris Rules, or really the Tim and Julie Harris Mid-Year Mastermind. It looks like it's going to take place the last Saturday in July. We are only going to sell 50 tickets. I know we could sell a lot more than that, but we're only going to sell 50 tickets. The tickets are going to be available first to our Premier coaching members, or rather to our Elite coaching members, VIP coaching members, and Premier coaching members, and then to non-coaching members, but there's pretty much no chance they're not going to be gobbled up on the first day or two. So if you're listening and you're not in Premier and you want to go to our Mid-Year Mastermind, that's what you're going to need to do. You're going to need to enroll. If you're listening and you are in one of our 3 programs, when I make that button live, I'll let everyone know about it on the private Facebook page. Make sure you do not screw around and overthink it. Just go grab a ticket. We're only going to do 50 seats, and that's it. It's going to be a small event. This is a non-selling event. It's a true mastermind, many of you have never been to a true mastermind before. Many of you go to these events thinking that you're going to an educational event and then discover it's just an event to sell you something. Nothing's going to be for sale at this event. It's a real honest God mastermind. It's going to be in Austin, Texas. It's going to be the last Saturday. It's going to really be effectively, Friday evening, all day Saturday, and then Sunday morning or Sunday, like half day if you're wanting to stay. But Saturday's the essence of the program. So that's going to be the order page for that. It's going to be going live here in the next probably day or so. So stay frosty on that. And if you've not yet registered for the Agent Millions event, it's an online, it's our online, really a mastermind, but really it's our top producing agents. And these are agents that most of them are selling 200-300 houses per year. There's 19 of them, and we also have folks from like the president of National Association of Realtors. We have other people that are also part of this event. We're doing these once a week, twice a week, maybe. It depends on how many people show interest. But just go to agentmillions.com, and you can register. It's a free online webinar. And, guys, it's interview style. So a lot of you love that because I'm able to ask all the hard questions, and most of them give us their complete answers, right? All right. So, Julie, let's just jump in where we left off yesterday.
Yeah, so now we're talking about, let's say that you are interested in investing in multifamily property, and or you have clients asking you about this or prospects asking you about this. So in yesterday's podcast, we discussed the benefits that multifamily space provides, but now we're going to look at how to actually calculate value. I think this will also help some of you guys that struggle with commercial BPOs and turn those down. So remember, part of our goal as your coaches or soon-to-be coaches is for you to be able to say, yes, it would be my pleasure to help you with that. Tell me more, instead of, that's not really my cup of tea, let me find you somebody, right? So in multifamily investing, it's all about net operating income, known as NOI, of the property, and the fact that the investor is purchasing the property based on an income stream. First, we've got to understand some key terms. So again, unlike residential, where they have to fall in love with it and decide where their Christmas tree is going to be, we are talking dollars and cents here, NOI. So what are operating expenses? That's simply costs that are incurred to maintain and run a property. So some examples for commercial real estate would be trash removal, snow plowing, pest control, lawn care, elevator maintenance, pool maintenance. These are operating expenses. So think of it in terms of how to operate your business. Your commercial investments, just like your single family homes, are a little mini business. In some cases, a medium size or a big business, but it's the cost to operate it. It's literally what it says, operating expenses. So next we have capital expenditure. An expenditure, a capital expenditure, is for an asset that will improve or extend the useful life of an existing asset for a period to exceed 1 year. Examples might be hot water tanks, driveways, roofs, HVAC units. Many investors set a budget, a set amount per unit each year to cover these types of expenses. They have a fund set up for capital expenditure. That would be the smart thing to do so that it doesn't sneak up on you with no funds to handle that. So you may have to set aside a larger amount depending on the age and the condition of the property. The capital expenditure figure falls below the net operating income, so it does not affect the value of the asset, but it does affect your cash flow, the money you see in your bottom line. That's why we have to know all of these terms, not just what is the net operating income, what is the cap rate. We need to also look at some of this capital expenditure. What are you going to be shelling out to take care of this property? Maybe it's brand new, built 6 months ago. That's going to be a lot cheaper than something that's maybe converted apartments to condos to what have you, and it's really old and needing everything. So,
Jules, let's level off there. No, you're fine. Let's level off there because it's important that people understand the life cycle of a lot of the things that are part of buildings. And this is the reason Julie and I always, this is the essence of the reason why Julie and I always, suggest you guys get started in singles first, single families. You can buy a single family and, you have one furnace, you have one roof, you have one driveway, you have one hot water tank. And listen to what I'm saying, you can get all those covered under like an American Home Shield warranty. So you can literally buy a single family rental property and you can put an American Home Shield warranty on it. And if any of that crap breaks, you can have the warranty replace it all. We have Home Shield warranties, American Home Shield warranties on all of our rentals. Well, you can't really do that in big multifamilies. So what you got to do is when you're looking at these multifamilies, a lot of times these things go for sale when they basically are maybe 5 years away from needing a massive amount of maintenance. And so when you're looking at furnaces, you got to know how long these things last. A really good high-end furnace doesn't really last longer than a crappy furnace. The only thing a really good high-end furnace is, it's more efficient, which means it hypothetically will cost less to use over its life cycle. But in most parts of the country, a furnace HVAC is only going to last 10 or 12 years. A dishwasher, the same thing. A refrigerator, the same thing. I mean, you could have a rental with a real high end. I mean, Julie and I have rentals in Vegas, and some of them have these really high end appliances. And like when those things break, you can get them fixed. You can get the parts replaced. Because the replacement refrigerator is going to cost like 30 grand, crazy stuff like that. So you really got to know what you're getting into before you, basically pull the plug on, or I'm sorry, push the button on any of these. And then also keep in mind the life cycle of all these types of things. Julie mentioned driveways. I mean, a concrete driveway, for example, will last like maybe 15 or 20 years, maybe 30 years, where a blacktop will last half that. A metal roof, here's something I learned when we moved to Texas and we started buying rentals. A metal roof will last 40 or 50 years, whereas an asphalt shingle roof will only last like 20. So again, have your eyes open when you're walking into these, because if they seem like a great deal, or if the net operating expenses seem really, really low, like, my gosh, this is a great building, you could just be seeing early warning signs of deferred maintenance.
That's a great segue into how to handle a cap rate. A lot of, I think, agents that are getting into this, or maybe don't know all the bits and pieces and moving parts, think that cap rate is the only thing. You just get that number and you decide, is it good or isn't it? But the age, what the expenses are, affects the cap rate. So these things are all related. That's why we're being so detailed with helping you guys figure this out. So what is your net operating income, your NOI? That's the annual income generated from a property minus the total operating expenses. Now you know what operating expenses are, and you can figure out your NOI. Now, cap rate, another term that freaks people out. The cap rate is the rate of return on an investment property based on income. Cap rates are specific to a market and are affected by the property class, A, B, C, or D, that you're investing in. A broker should be able to tell you the cap rate in his market. You guys should be able to figure out the cap rate. So what's a cap rate? It stands for capitalization rate, often referred to again as a cap rate. It's a fundamental concept used in commercial real estate. It is the rate of return on a real estate investment property based on the income the property is expected to generate. This metric is used to estimate the investor's potential return on his or her investment. So it's basically a rating. You're gauging how good or not good it is. Now, how do you figure it out? It is not an elaborate thing that requires calculus or anything like that. Thank goodness for me. So the capitalization rate of an investment can be calculated by, here's the big equation, divide the property's net operating income, or NOI, net operating income, by the current market value, which is your acquisition cost of a property. That's your purchase price, potentially. The cap rate equals net operating income divided by the current market value. Okay? So we're going to do an example, Tim. Nice, fun, big word problem, but stay with me. It's going to demonstrate a point about why cap rate matters and why it's not the only thing that matters. Are you ready?
Yeah, I love it. Good job. Keep going. Yes, I know where we're going here.
All right, perfect. So, because I think it's important to not just say what it is, but show them why they should care and how to use it. So, in the simplest of terms, a cap rate can be a useful tool when it comes to comparing similar real estate properties. Which one should you buy, in other words, or which one should your clients potentially buy? So let's say that James wants to buy an investment property for $900,000 and expects that it will generate $125,000 per year after operating costs. The cap rate for this investment would be 13.89%. That's $125,000 divided by $900,000, which is 0.1389, which really means 13.89%. Hopefully you guys follow me on that. Again, purchase price potentially $900,000, generating $125,000 per year after operating costs. So you got to figure all that in. And I would stop here for a second, Tim, because sometimes when commercial brokers tell you the cap rate, they can jimmy with this number and either not include all of the operating costs, maybe because they're doing that on purpose to jack the cap rate, or maybe they just don't know what those operating costs are. So you got to be careful with even getting this far in the math. But let's say that it's all the way it appears. The cap rate then is 13.89%. As James continues to search for the right investment property, he could now use this expected cap rate to gauge the possible return generated from any comparable properties in the same price range with expenses considered. Again, the capital expenditure is not part of that equation, but if you're looking at a $900,000 purchase price and you know that every single unit needs an air conditioning unit, well, you've got to factor that in too. So there's lots of questions to be asked here. But the cap rate's real-world applications are fairly complicated because of all those different factors. If we build upon the example James is looking at, let's presume he finds another property with the same expenses. However, I had a little thing flash on my screen. Okay, so same operating expenses, but with a cap rate of 7%. Well, it would be easy to think that James should purchase his first option because the cap rate's higher, right? Seems like the right move, but what if that building with the higher cap rate is an older rundown apartment building with high turnover, and the lower cap is a maybe modern office building with long-term corporate leases, and maybe it's in a superior location? Got to look at the big picture. It makes sense that the office building would have the higher appraised value due to age, possible extra amenities, and the makeup of its renters. So the first option comes with added risk along with the higher cap rate, things like vacancy rates, possible needed renovation and updates. With the first option, you're paying less with the opportunity of a higher return because of the added risk. Just as in the world of traditional securities, the difference in return or the cap rate can highlight a higher risk. James would have to address his risk tolerance along with the cap rate in making his decision. The cap rate is a good point. It's like a jumping off point to have something to work with to evaluate commercial real estate, but it is one of many factors. So that is my talk about valuation of these different multifamilies. And generally I use my residential brain as a default, but you can do that too. When you're evaluating a normal single family home, it is not that different. The only difference is that you're not taking into the cap rate, right? You're still looking at the viability of the house, the repairs, the age, is it rentable or not? If you did rent it, what would you get for it? You have most of that conversation already in your normal brain. We just have to add some of this math. Does that make sense, Tim? I'm just trying to link it all together for them.
It does, and here's where my mind went. Number one, guys, there's an old Ronald Reagan saying, it's called trust but verify, and we're, basically being as direct with you guys about this as possible. Just assume that the numbers you're being provided for any of these rental properties are packed, and when you get into these big multifamilies, well, let's just say you get into the small multifamilies, those are probably run by mom and pops, and they probably maybe didn't necessarily run that 5 family or that 10 family or whatever as efficiently as they could have. So you're going to have to basically take whatever documentation they give you, whatever they tell you the cap rate is, when they send over their expenses and all that. Look, that's just kind of like a starting point. You're going to need to go in there and you're going to need to verify, trust but verify. So one of the things that we've done in the past is we will go there to wherever this, the potential investment is, if it's a multifamily, and we'll actually go and talk to the neighbors. We'll talk to the people living there. If there's a property manager, it's usually a resident who's getting a break on his rent, when you say a 20 unit or less, and we'll just go and talk to him. What's up, man? What's this place really need? Well, it turns out the flat roofs on all the buildings are crapped out, and it turns out the termites have, whatever. I mean, you guys get the idea. So trust but verify. You really have to go in there and do some serious due diligence on all these types of investments. Obviously, this is less true on the newer projects because you're going to have, basically a lot of known knowledge because they're going to be newer buildings with newer appliances and newer everything else. But when you get into the older stuff, which is where most of you will start as you start, and maybe it's a great place to start, you're going to have to do a lot of your own homework. This is the reason why Julie and I always suggest you guys start with single families. Now, the next thing, and I mentioned this 3 or 4 shows ago, be very, very careful about buying in up and coming areas. Be very, very the only time in all the years that we've been buying rentals that we ever got screwed on a rental was when we did it to ourselves and bought one in this area that was up and coming. And it wasn't. It had gone and left. And this area was bad and got worse. You know what I'm talking about, right, Julie?
What we need is a little recession to just make sure that happens. And then, and honestly, I was surprised at how quickly that happened. It can turn on you. So when in doubt, if you're seeing bars on the window and the street next door to you is maybe okay, but the one next to that is not, you are too close to that risk. You have to have some rules and some filters set up. There is enough property in the world that you can always keep looking.
And and the other thing is, again, when you're starting, if you want the least amount of hassle when you're getting started, I'm not going to say you would live there, but buy a place that maybe you would live. It doesn't have to be super fancy or whatever, but you want to make sure that when you're there, you feel safe. When you're there walking around the house or the building, you don't see things that you wouldn't want your family exposed to. The only reason I'm suggesting is that it is because that'll give you a good indication of what kind of tenants you're going to get. Because at the end of the day, your experience with being a property investor, just like your experience owning a business, remember each of these units you buy is going to be a small business. Well, if you own a normal business, let's say, you own a laundromat, or you own, I don't even know what, a coin-op car wash or something, like that. And you have it in a bad part of town, and you have people abusing your equipment, abusing your staff, abusing everything. Well, that's not a very good investment, even if the cash flow is great, because it's going to be abusing you. So keep that in mind. And when you do start, again, with a small single-family house, consider buying the single-family house that is the perfect first-time buyer house or the first perfect downsizer house. Don't buy a house that's just a downsizer house, or don't buy a house that's just one or the other. Like, Julie and I look for areas that are near campuses, like colleges and whatnot, and we always look for homes that are near city centers. And here's the two reasons why. In a recession, those areas are, generally speaking, not adversely affected like areas that are further out, the bedroom community type places. So that's what we look for. And generally speaking, it's going to be older housing stock. In most major cities, these are going to be little houses that were built after World War II, especially true in the Midwest, but even out in California. These are going to be older. Well, out in California, be mostly in the 50s and 60s. But those types of houses, if you buy something that's too far away from where people work, or if you buy something that's, anything that's going to be basically a little bit too risky and the economy goes to hell and unemployment rises and all the rest of it, not as bad as it happened back in 2007, but the two recessions before that, what happens is those tenants have a tendency to lose their jobs and they can't afford to drive to work. And then you're dealing with a big mess. So if you look in cities, if you look like Julie and I mentioned 43214 in Columbus, Ohio, maybe I shouldn't have mentioned that because now the prices have gone crazy.
Hey,
but 43214, I know, Julie, I should just shut up, right? But 43214, 43085, these are areas that Julie and I used to live when we sold real estate, and bought rentals. And those areas were always fantastic. Now, they didn't always appreciate, when you sold real estate in Columbus, Ohio, and somebody asked what the appreciation rate was, there was no appreciation really. It was basically houses were keeping up with the rate of inflation, which is typically around 3%. So look, if you want to call appreciation the same, well, if you want to call appreciation the same thing as inflation, that's fine, but I don't. I think appreciation is anything over the inflation rate, but I'm just being a wonk. So, but here's the thing. You could buy a house in 43214, 43085, and for the longest time, until maybe like the last 5 or 6 years, they just appreciated very slowly and predictably. When the markets on the coast boomed, Columbus stayed the same. When the markets on the coast crashed, Columbus stayed the same, because it was 15, 20 minutes, those areas from the city center, the capital of the state. It was 15 or 20 minutes from Ohio State, the largest, university in the world, I guess. I think it still is. Something like 60,000 or more students go there, with all the ancillary campuses. And those are the types of areas you look. And there's tons of areas around the country like that. We mentioned around Butler University. We mentioned in North Carolina. There's lots happening in these little areas that have been considered to be sort of the second and third tier investment areas. Everyone, for the longest time,
there's other benefits too, though. When you tend to go towards those neighborhoods, you have lower taxes because they're closer to the city. They're not out in urban higher taxes. And number two, you don't have a homeowners association to wreck your cap rate. That'll dent some of the potential purchases that these guys look at sometimes. You might have a great opportunity to buy in a condo building, but you still have to factor in all of those dues and fees and all that kind of fun stuff. So, even parts of Arizona, it's not just an HOA. You also have a tribal fee, or on Indian land, you've got an HOA plus another fee. So you got to look into that. This is not the only place for you guys to look, but it's a good place to get started. And I would say the third benefit is that type of thing is a lot easier to sell, whether it's a recession or not, because more people can afford the normal single-family home, first, second-time buyer type of price range than buying too high up and speculating that you're on the ascension and that the market's going to catch you. So it takes a lot of noodling on this, and that's why one of our previous homeworks from when we started this series of podcasts was to actually get to know your market. Where are the pockets where you live, and maybe there aren't any, but maybe there are, that make for some potential great investment. If you've never seen a multifamily, take yourself on a preview tour, see what is actually available. Usually there's a unit that you can see in a building or something of that nature. Maybe you're curious about strip malls or about office plexes. you have to educate yourself on that stuff so that you can have the right answers, and so you can stop saying no to prospects who are asking you about these things. Make sense?
Here's the basic formula that all of you should seriously consider adopting. This is what Julie and I figured out. I mean, almost 3 decades ago. It's amazing to think, isn't it? So our original premise was basically we wanted to have rental properties producing enough cash flow that cash flow covered our personal overhead. That was it. Those are simple, idea. And so really to make that happen, and again, you guys can use Real Estate Treasure Map. There's a lot of math in there to help you drill down on your personal and business expenses. But the real idea was that once we got to that point, and this you have financial freedom, right? If you have cash flow coming in to pay for your lifestyle, well, some of you have really expensive lifestyles, so it'll take longer. Some of you have, just other financial obstacles that you're going to have to overcome, so it might take longer. But for the most part, everybody listening, when you follow that simple formula, you'll be able to have financial freedom faster than you think. We've had coaching clients who have heard us say this, and they've basically jumped in with 2 feet. They've sacrificed their lifestyle today with the idea that they could be financially free. And I have absolutely had coaching clients that within 2 or 3 years, they trimmed down their personal expenses. They basically took kids out of private schools, canceled memberships to, country clubs, stopped leasing expensive cars. They really did the Dave Ramsey thing and paid off all their debt. And then what they did is they basically started buying rental properties and they paid them off. And now those rental properties, are typically producing $7,000, $10,000 a month in positive cash flow. Now, here's the miraculous thing. When that actually happens, when you can create that in your life, you don't stop working. You actually work differently. In other words, you're a lot more careful with your time, and you would then have the choice of who you work with. So that's the real freedom that comes from, I don't know of any other way to do it, guys. Look, most of us are never going to have a rich uncle that's going to leave us a bunch of money. Most of us are never going to, have an IPO. Most of us are never going to buy a winning lottery ticket. Most of us are never going to have any kind of real liquidity event other than the ones we create for ourselves. And so tomorrow, the next day, and I'm guessing probably 2 or 3 more shows after that, we're going to continue to drill down. One of the shows I'm really looking forward to helping you guys with is how to figure out how to actually finance these things. Because as licensees, many of you don't realize this, but you can use your commission to finance these deals. You can use your commission as part of your down payment. In some cases, you're going to be able to use your commission plus a second mortgage from the seller to come up with all your down payment so you don't have to save any cash. So we're going to explain to you guys how to do that. But do seriously go back and listen to the other shows we've done on this particular topic. Don't be overwhelmed by, sometimes there's tons of information out there available nowadays on YouTube and all these other places. But what happens is you go from zero, knowing very little, to all of a sudden you're now having to, master all this complicated math. That's the reason Julie and I suggest you start with a single family house. Something simple, and then once you realize how frankly easy it is, then you're going to want to buy more. And that's how it always works. So if you guys need us for anything, we're easy to reach, right? All of you know that. Tim at timandjulieharris.com or Julie at timandjulieharris.com. Those of you interested in attending our mid-year mastermind, the Eventbrite page is going to go live hopefully this week. It's going to be available to Premier Coaching members, VIP Coaching members, and Elite Coaching members first. But then the rest of you who are not coaching members, which you really should be coaching members, will have an opportunity to join us too. It's going to be just in Austin, Texas. It's going to be the last Saturday of July. It's going to actually be basically a 3-day event, but the bulk of the event's going to happen on the 27th of July, I believe. So a lot of announcements are going to be coming about that over the next couple of days. You guys have a fantastic day. We'll talk to you on the show tomorrow.
This program has been a presentation by Tim and Julie Harris, Real Estate Coaching. For more information on our real estate coaching and training programs, visit our website at timandjulieharris.com. Remember to tune in weekdays at noon for upcoming shows. And until next time, thank you for listening to Real Estate Coaching Radio with Tim and Julie Harris.